Good afternoon, everyone. Thanks for joining our Endowus Q1 2025 Market Insights and Portfolio Performance Review. My name is Hugh Chung. I'm the Chief Investment Officer at Endowus. I'm joined by my colleague, Geoffrey Tan, who is a Senior Investment Lead. We'll go through some disclaimers before we head up, talk about the contents. Please make sure to ask your questions on Slido, as you can sign up using this QR code, and we will be able to answer questions live after we go through with our presentation. Next page, please. So I know a lot of you are familiar with Endowus, but just a very quick recap of who we are. We are a conflict-free institutional access and low fare fee digital wealth platform that started in Singapore and now have offices in Hong Kong and Singapore. The vast majority of our investors are actually Endowus employees, but we are also backed by some of the most established organizations out there, including UBS, Citi, Singtel, Samsung, etc. Next page. So with that, I will hand it straight over to Geoff, who will go over the Q1 market review as well as Q1 markets. After that, I will discuss some of our insights and the changes that have happened since Q1, which is quite a lot in this market. So without further ado, I'll hand it over to Geoff.
Thank you, Hugh. Good afternoon, everyone. I will first start with a brief market recap for the last quarter. So starting with equities, on the back of strong tech performance in the last quarter of last year, in the quarter four of last year, US equities started the year on a very strong note. S&P 500 briefly touching a new high in early Feb. The new administration's pro-business stance, America First policy, as well as ongoing Western AI leadership provided tailwinds in January. However, by mid-Feb, this trend reversed, and we started to see a rotation out of US equities into China, particularly China tech, as well as European equities. Now, a number of factors actually accounted for this. First, the AI breakthrough by China's DeepSeek, which challenged US AI incumbents, and China's fiscal stimulus package that helped lift confidence in Chinese equities. Second, fiscal stimulus announced in Europe and Germany's 500 billion infrastructure investment fund, plus its commitment to more defense spending, boosted growth expectations in the EU. And third, tariff announcements in March weighed on US growth expectations and sentiment. So with that, this chart shows you that divergence at play. You can see that by the end of the quarter, China and European equities outperformed, while US and Japan equities pulled back. On the next slide, here you can see that unlike the last 2 years when tech stocks actually dominated, last quarter we saw a very different narrative being played out. And in fact, if you look closely, you see that the value defensive sectors such as energy, financials, utilities were the ones that rallied, while popular growth sectors such as tech, communication services, and discretionary fell. And if we move to the next slide, we just briefly go over how fixed income markets did in the last quarter. So in general, we saw higher quality assets perform relatively well. Bonds were supported in the first quarter with rising investor pessimism and concerns over growth. From a policy standpoint, the Fed kept rates on hold at 4.25 to 4.5 last quarter, but revised its 2025 growth expectations lower from 2.1 to 1.7%. High quality assets such as US Treasuries benefited, and we saw the 10-year US Treasury yield fall from 4.58 end of last year to 3.9 by the end of March. And this, of course, changed in April, as we will discuss a bit more later. Inflation-linked bonds was also performing well as real yields fell, driven by concerns over rising inflation. And investment-grade credit showed resilience despite the threat to growth. Strong corporate fundamentals helped to contain spread widening in the IG space. And finally, a weaker US dollar provided some support for emerging market debt. So with that in mind, let's see how our portfolios perform in the first quarter. Can we have the next slide, please? So we'll first start with our cash and SRS portfolios. The flagship cash SRS 100% equity portfolio fell minus 2.9% in the first quarter, performing in line with broader global equity markets. The portfolio's structural overweight to value stocks and EM supported performance. However, this was offset by a tilt towards smaller caps, which underperformed. As we saw earlier, value stocks outpaced their growth counterparts as global investors shifted away from highly valued US tech stocks. And as a result, the two passive US index funds by Amundi and iShares were the weakest performers. And on the other hand, the two EM equity funds by Amundi and Dimensional delivered the strongest returns. And over to the fixed income side, the 100% fixed income portfolio rose 1.4% in the first quarter, outperforming the benchmark by 60 basis points. With the US bond yields rallying in the first quarter, the fixed income backdrop was generally constructive. Gains were led by allocations to high-quality securitized bonds, such as through PIMCO Income, and emerging market debt via PIMCO EM bond fund. Now, PIMCO Income was the top performer in the fixed income sleeve, returning 2.9%, while PIMCO EM bond fund, which is a portfolio of EM hard currency debt, returned 2.7%, supported by a weaker dollar. Other funds in the portfolio either matched or slightly exceeded their benchmarks. And with that, we will move on to the CPF portfolios in the next slide. So on the equity side, the 100% equity CPF portfolio declined minus 3.2% in the first quarter, underperforming the global equities benchmark. The portfolio's structural overweight to US equities weighed on performance. However, this was mitigated by an overweight to emerging market equities, which did well, and a slight tilt towards value stocks through Dimensional, as you know. The best performing funds in the equity sleeve were the two EM equity funds by Schroders and Dimensional, which were up 0.8 and 0.7% respectively. Now on the fixed income side, the fixed income portfolio returned 0.8% in the first quarter, performing in line with broader fixed income. The eSpring Singapore Select Bond Fund, which is primarily in Sing and foreign issuers, led the gains in this segment, rising 1.6%. Second in line was the short duration UOB United SGD, up 1.1%. And on the other hand, Dimensional Global Core Fixed Income Fund was the weaker performer, posting a modest increase of plus 0.6% for the quarter. So that was CPF. Now let's move on to the next slide where we'll look at our three income portfolios. Maybe as just a quick recap before we go into performance. Some of you may be familiar with stable income, higher and future, but I just wanted to do a quick recap. So stable income is 100% fixed income and focused primarily on income, and it has no equity risk in there. Higher income introduces dividend-paying equities up to a 20% allocation and has more high yield. And finally, future income adds to global equities, increasing the overall equity allocation to 40%. So with that in mind, let's quickly talk about payouts. Quickly, in terms of payouts, all three income portfolios are achieving their payout targets. Stable income has a payout target of 5 to 6%, currently at 5.8%. Higher income is a payout target of 5.5 to 6.5%. Currently, it's also at 5.8%. And future income with a payout target of 3.5 to 4.5%, currently at 4.2%. So with that, let's quickly look at the performance. We'll start with stable income. So stable income gained 2% in the first quarter, outperforming the broader credit market. Most of the positive returns were registered in the first 2 months of the year, while in March, the portfolio managed to be relatively resilient despite market jitters. Most of the underlying funds contributed to relative performance. PIMCO Income Fund was the best performer, returning 2.9%. And this was because their larger weight to securitized credit, in particular, agency mortgage-backed securities, which performed well, as we saw earlier. Higher income gained 1.1% in the first quarter and outperformed the 2080 benchmark. On the fixed income side of the portfolio, It outperformed the broader credit market. While investment grade contributed to performance, high yield detracted as spreads widened on higher recession concerns. And on the equity side, the equity part of the portfolio outperformed the broader equities market. While we saw that US equities detracted, the portfolio's overweight exposure to EM and Asian equities actually helped, as both markets outperformed the US equity market. The exposure to real estate and infrastructure equities also contributed positively. And finally, currency hedging of the underlying funds was a positive contributor as the dollar depreciated against the Sing over the quarter. And then finally, to future income, which is a 40/60 portfolio, future income gained 0.5% in the first quarter, outperforming the 40/60 benchmark. On the fixed income side, which mirrors stable income, we saw that did better than the benchmark earlier. And on the equity side, the equity component also outperformed the broader equities market, with European and EM equities contributing, while US equities contributed negatively. And similarly, currency hedging in some of the underlying funds contributed, with US dollar weakening over the quarter. So with that, just wanted to give some final comments on the income portfolios to remind everyone. As some of you would know, with higher base rates and elevated yield environment post-2023, investment grade bonds have been able to provide attractive income and yield relative to high yield bonds. In November 2023, Endowus Investment Office performed an RPC, or recommended portfolio change, to improve the overall credit quality of our income portfolios while maintaining the payout ratio. Put simply, we were able to maintain target returns while lowering the credit risk for you. At IO, we continue to monitor evolving market conditions, and where there are opportunities to improve the risk return of a portfolio, not just for income, but across all portfolios, we will alert you via an RPC. Lastly, let's take a look at our cash smart portfolios. In general, the cash smart portfolios delivered positive, attractive returns in Q1 on the back of falling rates. Cash smart secure was up 0.7%, and it saw consistent positive monthly returns in the first 3 months of the year. Both Fullerton Sing Dollar Cash Fund and Line Global SGD Enhanced Liquidity were resilient and contributed positive returns during a volatile quarter. If you recall, Cash Smart Secure is our most conservative solution for short-term cash. Cash Smart Enhanced was up 0.9% in the first quarter. All underlying funds contributed positively in Q1, although the United SGD Fund experienced a bit more volatility in March due to broader market uncertainty. Overall, the portfolio generated a middle ground return within the Cash Smart suite. And then finally, Cash Smart Ultra. Cash Smart Ultra was up 1.1%. It finished the quarter with the strongest return among the Cash Smart range, with its additional exposure to short duration bond funds. This portfolio may be suitable for investors who can take on more credit and more duration risk in return for a higher return potential. Before we move on, I thought it's worth mentioning an important point. So Cash Smart portfolios, mainly exposed in dollar and Sing rates, are seeing some declining projected yields as markets enter a rate cutting cycle. We would encourage you to review your investment goals and decide whether your current Cash Smart portfolio remains aligned with your needs. That wraps up our Q1 performance section. You may find more details on the performance of our satellite portfolios on our website, available now actually. This quarter especially highlights, I would say, the importance of maintaining a globally diversified portfolio across bonds and equities. For example, while the S&P 500 was down minus 5.7% in the first quarter, a balanced 60/40 flagship cash SRS was only down minus 1.2%. As always, feel free to reach out to our advisors should you have any questions that arise. Now I would like to pass the time back to Hugh, who will walk you through some market insights.
Thank you. Okay. Thank you, Geoff. So let's walk through some market insights. I know it's been a very turbulent period with a lot of uncertainty, and we just covered Q1, but it feels like the last 22 days in April, seem to have brought even more uncertainty. So with that, maybe go to the next slide. The purpose of what we're going through now is not to give you a forecast of what's going to come, because I don't think anyone really knows what's going to happen, particularly over the short term. But it is really to try to give you a little bit of perspective on what had happened. And if you look at this chart, this is an year-to-date growth chart of S&P 500. Clearly, it has struggled, particularly over the last few weeks, especially after what we call Liberation Day, where Trump announced tariffs and there were, escalating tariff risks, particularly with China. You can see that there's been a lot of volatility. And just when, the market was more discouraged, there was positive news of a 90-day pause, which had given one of the largest spikes, in the S&P 500 over the last few years, which goes to show you that even during weak markets, there's a lot of positive days as well. But as of April 14th, S&P 500 year to date was down 11.1%. Now, if you go to the next page, though, only looking at it on a one-year basis, you can see that despite the volatility that we're seeing over the last few weeks or so, only on a one-year basis is still positive territory for the S&P 500. So I think we really want to look at this from a larger perspective. Next page. And, again, looking at it even further out on a 7-year basis, and the reason why we took a 7-year period was because this was actually a pretty unique 7-year period where we saw 4 bear markets. And the definition of a bear market is a 20% decline in the price. And if you look at S&P 500, it's very unusual to actually have this much volatility over a short period of time. But if you look at what happened in the fourth quarter of 2018, that was a period when, and back then there was another tariff concern, but that was a period when growth concerns translated into the Fed having to pivot at the beginning of 2019. So there was a natural cyclical slowdown, which actually translated into Fed taking action. But after that, we saw what we call an external shock slowdown, given the COVID pandemic, which everyone should be aware of. And that was a period when nobody could have predicted what had happened. But then what's important is that because of that external shock that happened in COVID, that translated into a supply-demand imbalance, which translated into higher inflation and therefore the Fed hiking rates, which in turn slowed down the economy. So therefore had a cyclical downturn in 2022. And both equities and bonds struggle because while equities struggle from a cyclical slowdown, bonds actually suffer from interest rates going higher. Now, this time around, we have another shock, which could be defined as an external shock in the sense that the tariff announcements triggered a very rapid change in the market. So the question now is this shock going to have an impact in the future and therefore affect the growth outlook as well? So, a lot of different people have different views on that. But I think for us, the most important thing is to understand that over a long-term period, financial markets are actually performing the way it should be. And it really depends on the horizon that you have and the amount of risk that you're willing to take in order to really, partake in this investment journey. But the reason why we show this is to show that this has happened before. And every time it does actually recover back, the magnitude and the speed is something that is very, very difficult to predict. Next page. Another thing that's happened, and there's a lot of questions coming in again, is only a while back we were talking about how US could do no wrong, how US equities have performed very well. Only until beginning of this year, we were getting polls and people were saying US equities will still be the best performing market this year. And only a while back, we got a lot of questions on why do we bother with global equities anyway? Why don't we just buy S&P 500? So things have changed a lot. And what we can show you here is that the divergence between US and the rest of the world have been narrowing, and this trend could continue going forward. Next page. The same thing is happening with different asset classes. Again, global equities over a long period of time tends to show the highest annualized returns, but there are these periods of turbulence like we're seeing now when commodities, which is actually a long-term underperformer, seeing the light of its day and proving that it is actually, an asset class that is worthy of being part of a portfolio. So with having kind of the understanding of different asset classes is very important. And the other thing that's happening is that global fixed income, which Geoff alluded to in Q1, has really, performed or, fulfilled its role as a diversifier and a vol dampener in a portfolio. And having said that, obviously in April, I'll go through that in a minute, things have changed a bit. But over time, the importance here is that it is very important to have perspective and have diversified asset classes, even though at the time it feels like it's either a burden or it doesn't really fulfill a role. Next page. The other thing that's worth looking at, obviously, is interest rates. And if you look at the chart on the left, interest rates have become a lot higher than it was back in the early 2020s and before. And what's important here is that if you take a longer look at the multi-decade period of interest rates, the 4% type yield that we're seeing, 4.5% type yield, is actually not very high, right? It's actually quite similar to what it was in the 90s. It's much lower than what it was in the 80s. And if you recall, equity performance during the 1990s was actually very good. So it's not necessarily the absolute level of interest rates. It's actually the speed of how fast it got there that really created that problem in 2022. So again, perspective is another important takeaway when looking at these situations as well. Next page. And another thing worth mentioning is that market is terrible at forecasting, particularly interest rates and stock markets. This is a chart showing the probability of four rate cuts over a 12-month period. Only in September 2024, the market was expecting 8 rate cuts, and then that to have gone to close to zero by January 2025, or the probability of 8 cuts going to zero by Jan 2025. And then the probability of a hike going higher. So right now, just last week, Chair Powell was out saying he's kind of stuck between a rock and a hard place because growth is slowing, but inflation is quite sticky, and therefore it's going to be very difficult to cut interest rates. So again, that situation could change in a few months as well. So the point, again, takeaway here is that it's very, very difficult to predict the markets. And therefore, you should always go from a first principles basis of creating a goal and managing that risk. Next page. So again, there's a few things you can do with your money. You can spend it, you can save, you can speculate. Our recommendation is to invest and get compensated for the compounded returns. Next page. So before I go to Q&A, I did want to kind of mention one other point, which wasn't part of this slide, which I think is quite relevant right now and is also related to some of the questions that are coming in, which is regarding currency as well as interest rates. And I just mentioned interest rates just now. One of the things that we're seeing right now is a divergence between the US 10-year Treasury and the dollar. So the dollar is weakening while US Treasury rates are actually, if anything, higher. And to me, this is suggesting that the confidence within US assets and US currency has been declining, and for a lot of them, good reasons, given all the geopolitical and tariff-related news happening. Now, having said that, given this divergence, what could easily also happen is that as there is a little bit more confidence built back, that divergence that happened between interest rates and the dollar weakness could converge as well, right? So again, it's very difficult to predict the path of the dollar. And I would much rather us think about our liabilities, where our cost base is. If it's Sing dollar, then you should try to have as much Sing dollar exposure as possible, and vice versa. So rather than try to predict where the dollar is headed, I think it's very important for us to make sure that on a first principles basis, our goal and risk and what we can tolerate are aligned. So with that, we'll actually go over some of the questions. I know some of the questions will ask these questions, and we'll go over a little bit more detail as well. So let's look at the questions first. One question, which is the top voted question here, I will take first, which is, seems like some of the dimensional funds are always the underperformer. Why does Endowus feel that they continue to have a place in the flagship portfolio? So let me address this question first. So you're right, dimensional funds have actually, in some cases, have been struggling, particularly over the last 10 years. The reason is because dimensional uses evidence-based factors that have worked over a 40-year period, and those are value, small cap, as well as profitability. And profitability is also sometimes in high relation to quality, right? And if you look at the kind of factors that have really driven markets over the last decade, it really has been growth, particularly in the US market, as well as large caps outperforming small caps. So those were headwinds for dimensional funds. Having said that, even with those factor tilts, dimensional on those kind of factor adjusted basis has actually done reasonably well. And if you look at different periods, like 3 years, and what Geoff has gone through just even year to date, it actually hasn't underperformed, given its value tilt has actually outperformed growth. It's really the small caps factor that has been struggling year to date. So the reason we continue to have dimensional in the flagship portfolios is because it is a systematic piece of the flagship. And just to remind you, flagship has 3 different pieces. One is systematic, one is passive index, and the other one is active. And the active piece, which is largely in the form of fixed income and PIMCO, has actually continued to outperform and did its part. Even like you saw during the Q1Q fixed income update, passive index funds are the low-cost index funds. But really, for a lot of our equity exposure, we think that over a long period of time, having an evidence-based factor approach will pay off over the long run. And that's why we still have it in the portfolio. And actually this year, it is actually shaping up to be a year where this is, kind of starting to pay off as well. So maybe, Geoff, you want to take a few questions on the FX side?
Yes. Maybe I'll take the next question, which has been upvoted. 5 votes. How can SG investors protect themselves from dollar devaluation? Investing in dollar assets, redeeming them in Sing would result in FX losses, risk if dollar devalues. I think to address that question, yes, dollar has been depreciating in the first quarter alone. I think it's the DXY is down something like 9% as of yesterday. So definitely we've seen quite a bit of dollar weakness in the first quarter. In terms of how investors, our clients, can help to position themselves to protect a little bit better in terms of the FX, we do offer at Endowus, Sing dollar hedge share classes for a lot of our funds and portfolios as well. So to give you an example, the fixed income components of, say, our flagship, for example, are Sing dollar hedged. The stable income, future income, as well as higher income portfolios on the bond side are all Sing dollar hedged. There is a large degree of hedging involved there, which will help to protect the portfolios overall from a dollar devaluation. So I think that you can consider when it comes to protecting against dollar devaluation.
I'll take a related question, because another question here says, how to position portfolio against de-dollarization of USD? Gold is a hedge, but does not produce dividend or growth. Are there better alternatives? So I think there is no easy answer to this, because the fact that you are investing in global investments, and just to remind you, US is about 60% of all global equities and a significant part of the bond market as well. So it's very difficult to quote unquote avoid US exposure if you really want to be globally diversified. And over the long run, that is the proven evidence-based method, right? So that'll be the first question. And sorry, the first answer. The second thing is that if you hedge against the dollar completely, the hedging costs are quite high as well. So there is no easy solution to that. Having said that, I do think that there are other options. So for example, we didn't mention it on the webinar, but in our website and in our article, you can check out some of our satellites. One satellite portfolio that I wanted to highlight today was actually our real assets satellite portfolio, which consists of infrastructure, real estate, and commodities. And this portfolio has actually outperformed global equities close to 9% year to date. And by year to date, I mean as of last few days ago, not as of end of March. And a lot of it was helped by performance from commodities and infrastructure, and this is SGD based, right? So this is SGD return. So there are other ways to, I think, dampen the blow into a situation like this, but a direct like-for-like hedge of not having any US dollar would only mean that you are also concentrated in something else. So for example, I know the questioner here isn't suggesting that you own a lot of gold. Gold has its purpose and it's doing what it's supposed to do. But again, the gold, kind of concentration almost of everyone kind of flocking into gold is potentially a risk in itself, right? So just like 6 months ago, the Max 7 couldn't do anything wrong. Now nobody wants to own it. So I think these situations change as times change. So everything has to come into moderation. So these are other different areas that you can think of.
I think I can go ahead and take the next couple of questions on portfolio strategy. I think there's a question from Cynthia on strategies you can use to stay agile and adapt portfolios quickly to changing conditions. There's another question also on how would you invest in today's climate? And the third question is also on overweight, underweights. I think together, looking at these questions, I think very importantly, when we take a step back, look at how we invest today for our clients, how we advise, we always tell clients to stay close to their goals, right? First of all, think about how long your time horizon is, what your risk appetite is. And with that, you're able to then understand how much equity risk you can take, right, in relation to fixed income. I think that's a very important first step to take to establish your core portfolio. Now, of course, some of us may have some ideas that maybe we want to have a bit more exposure here and there. You can always go into our FundSmart platform to customize and choose funds to add on to the core portfolio, or even supplement the core with other satellite portfolios. As Hugh mentioned one earlier, the real assets portfolio, which is one that's shaping to be quite important in this environment where we see stagflation, lower growth, higher inflation. That could be something that you could use to complement the core as an add-on, right? So that's definitely something. The other piece on overweight, underweights, I think the answer to that one is that we don't normally look at markets in that way. We adopt a strategic passive asset allocation, or SPAA for short, which is essentially saying that we will allocate strategically to different markets, both across equities and fixed income. We don't take overweight, underweights. And so that is the approach that we take. We don't do short-term, quarter-to-quarter views like that. So importantly, goals in order to identify what kind of solutions could be suitable for you. And maybe just to add on, if you're looking for something more income-based and you don't want to take on too much risk, you can look at our stable income solution. Today, that's yielding about, I believe it's 5.8% on the Sing Dollar portfolio. We mentioned that earlier. That could be a portfolio you can look at if you could take on a bit more credit risk. That, of course, is a little bit riskier than our flagship 100% fixed income, which is less corporates and more governments, hence the yield's a bit lower. But that's the options you can choose as a core if you're an income-oriented investor. in terms of monthly payouts, that will be your stable income. So that could be a bit more suitable. And if you're looking for more equity risk, a bit more growth, then of course you can look at our flagship, either 60/40, 80/20, or even 100/0 on the flagship equity side.
Yeah, just to echo onto what Geoff had just said, that allocation based on our CIO views, it's really a goal-based, on a personal risk tolerance level. But I understand the question of, oh, I'm worried about the future. It seems like things are getting worse. So what can I do about it? So it is actually a time to potentially reassess your risk appetite, because maybe you weren't as pro-risk as you thought you were, and this could be a time to kind of readjust that. And then we have the tools to adjust that, which, as Geoff said, you could allocate into more of a fixed income type portfolio, or you can augment it, adding real assets, particularly if you feel a recession is near. Having said that, if you look at the reason I go back to the 7-year chart, if you remember what happened during 2023, or even some of the earlier periods, there were periods where people were sure there would be a recession. They were sure this would happen. They were sure that would happen. And normally, a lot of that had been priced in already, and the opposite starts to happen, right? So that's why it's very, very difficult to predict that. And we may even be in a recession right now. So, for example, if you look at the tariff situation of all this to and fro, from applying tariffs to delaying tariffs to all of that, what that does to potential actual companies running businesses is that it makes them really difficult to make decisions, which means that economy may be slowing down. But from a market's perspective, that could be what's already being priced in as well, right? So what's really difficult, particularly for professionals as well, is to really determine, how much of that is happening and how much that is priced in, right? So the question is always like, oh, if a recession happens, what do I do? What do I do? A lot of times, it's very possible that that's already being processed and priced into the markets, that you may already be late, right? So it's always best to do the first principle based of, keeping, again, inside of what my goal was, and then just, kind of reassessing whether the way I had expressed that view was the right one to begin with. So the staying agile and adapting portfolios part sometimes sounds very enticing, because you're doing something to improve your portfolio, but sometimes it tends to be a reaction to a market event which had already potentially could have been priced in. So just wanted to kind of mention that. Will there be a portfolio change recommendation in coming weeks? So I think I partially answered that, but the way, it's not like we have a model portfolio where we are overweight equities, overweight China, et cetera. We don't take that approach, and therefore that doesn't mean that we will change recommendations either way. The only time we really do what we call a recommended portfolio change is either if there is a systematic reason where we should make a change. For example, if we found a much cheaper share class, like we had done with our flagship in the past, or if we found a way to de-risk the portfolio while maintaining the same amount of yield, like Geoff had mentioned on our stable income portfolio, or what we did with our real assets portfolio. We originally was a real estate portfolio, but we thought it was systematically a good reason to add infrastructure and commodities, and that turned out to be a great decision as well. So these are the times we change portfolios. It's not to have specific views on equities or bonds or so on. Okay, maybe I'll take the next question as well, which is just on the Treasury side, and I think briefly mentioned it last time. And this is something definitely worth taking a close look at. And the question is, are we seeing the risk-free asset of US Treasuries being risk-full? What does it mean for investors? So I think, like we had seen with the Treasury rates moving higher and a dollar moving lower, and that gap widening, which is a fairly uncommon situation, it shows you that the credibility of U.S. assets and U.S. Currency is quite low, and for different reasons that you can all read about in the news. Now, U.S. Treasury still, as an asset class, is something that's very, very difficult to replace because there's really no alternative. So it's not a risk-free asset in the sense that as long as there is a long duration, there is a duration risk. But from a credit spread perspective, it is still widely considered close to a risk-free asset, given that U.S. as a sovereign and a counterpart is still very difficult to, replace, right? So I don't think we should think of U.S. Treasuries as a risk-full asset, but again, given the different durations of U.S. Treasury, there is definitely duration risk of investing in U.S. Treasuries. But for example, the overnight T-bills, et cetera, or 3-month T-bills and overnight Treasuries and so on, these I think you can still consider as quite close to risk-free assets.
There is a question on US dollar as a reserve currency status in the middle and long term. Do you see any changes to that? I think Hugh may have alluded to this already earlier, but I did some research on this, so just wanted to share with everyone. The US dollar still remains the world's primary reserve currency. It is most widely used for international trade and is the dominant currency in global capital markets today, right? US is also the most liquid and most deep market in the world. Most of the world's oil is sold in US dollars. When you look at the data and the trend over the last, easily 8 to 10 years, you can see actually dollar as a proportion of reserve currencies by central banks around the world is actually around 58% today, right? 58% of all the FX reserves are held in US dollars. And that actually has been trending lower, but quite slowly. But over time, over the last 8 years, it's trended down a couple of percentage points only. And if you're curious who's next in line, 20% is in euros and another 20% in other currencies, ex-US, ex-renminbi, ex-euro. The sterling is around 5%. But I think the message really is that, as Hugh has pointed out, the US dollar, there's still very little alternative, although increasingly we do understand that there's been some concerns around the short term around policy in the US, which we are monitoring very closely.
I think there are a few very similar questions, and some of it is a repeat of what we had discussed before. But just to clarify, there is also a question on gold. Gold has outperformed. Your competitors offer it in portfolios. Will you be? So the current situation is we do have a gold fund that closely tracks gold. This is only available for accredited investors. It actually also, you can actually take hold of physical gold through this fund as well. But the reason we cannot provide gold direct exposure is because we don't have ETFs on our platform, and there are no retail registered gold funds as well. So unless we allow ETFs, it will not be on our platform, but we are looking at ETFs as well. The other thing is on, again, questions on recessions. How do you recession-proof, or how do you make portfolios more resilient? Again, I don't think we should think about moving our entire portfolio into a quote-unquote recession-proof portfolio, because if that recession, ends up being very short-lived, then you will also have a lot of opportunity costs. Having said that, just by principle, if you increase your, kind of quality of bonds, as well as potentially even duration, and reduce risk assets, also potentially increasing infrastructure and other real assets, those would be ways to potentially increase the resilience, or not, put another way, you can actually reduce your dependency on GDP growth as a driver of performance as well. So so if you look at the global financial crisis, during that period, global equities were down more than 50%, but actually 10-year Treasury was up. So depending on how much credit spread you had at the time, fixed income had different levels of performance, right? So you can look at these levers, but again, having said that, it's very difficult to create a portfolio just in protection for a recession, and then once that doesn't happen, then to be okay again, right? So creating these all-weather portfolios are very, very difficult. So again, the best thing is to again go to the goal-based approach and have your risk mitigated, risk kind of counted for. But again, on the margin, increasing high-quality bonds and potentially adding some real assets would probably be better in terms of reducing volatility and also having some protection when growth slows down.
Okay, maybe I can take the next question, which is on yields. So Stephen asked a question: with high yield selling off US bonds, will the income portfolio distribution yield be affected and potentially reduced? So on income, and I get a lot of questions on this portfolio, let's talk about maybe stable income, for example. If we look at how the last few quarters has been playing out and what the trend has been like for stable income in terms of its distribution yield, it's actually been relatively stable in terms of relatively consistent in terms of that range of 5 to 6%. Today, if we look at it as of the last month's distribution yield across the portfolio, it's 5.8, which is on the higher end of that range, right? Now, if you want to think about where yields can possibly go, I think there are two aspects you can think about. One is, of course, as you know, bonds are made up of two parts, right? Risk-free rate as well as the spread. Where risk-free rate or the treasury rates go can be quite difficult, as you can imagine, to put a finger to, right? So that's one part of the equation. The other part of the equation is credit spreads. Now, credit spreads, as we know, has been widening year to date, and high yield has widened a bit more than investment grade. High yield investment grade has actually widened in the first quarter less than 20 basis points, so not a whole lot. But in terms of credit spread widening, I think that could be something that could make yields a little bit more attractive in the nearer term, as we've seen yields already back up, right? So I think in the shorter term, yes, we may see yields a little bit higher, but I think to bring that back again to how we should think about our asset allocation, I think we need to be very clear on our goals. And if income is the primary objective in our goals, in our investment journey, I think stable income still remains the I guess the bit more conservative way to get access to income of the three portfolios. If you're looking at something a bit with okay to take more high yield, you can look at a higher income, which takes on 20% dividend paying equities and also takes on a bit more high yield. And quite arguably today they're yielding the same, 5.8 each. But in a more normal environment, if you take on more high yield, you take on more risk from dividend paying equities, you expect to be compensated a bit more. So it's a bit of an anomaly right now where high income, stable income are yielding around the same. Over the longer term, I think we expect that to normalize, right?
I just want to add one thing that's very important is that let's say you've bought or you're invested into stable income and the interest rates go down dramatically and therefore your distribution yield goes down. You have to remember that if you were already invested and that situation happened, yes, distribution yield will probably go down in the future or as it progresses, but you have already gained the capital return of interest rates going down in the process. So from a total return perspective, it's not such a bad outcome compared to having money market funds, having, let's say, 3% yield, 2-point-something% yield, and interest rates go down. You don't get the benefit of the capital returns, but your distribution yield goes down or your effective yield goes down, right? So and that's why it's also important to be in bonds. And in the past, we did share a long-term comparison between bonds and money market funds, whereby over the long run, bonds will almost always outperform, cash returns. The only exception recently was in 2022 when there was a rapid increase in interest rates. But just wanted to make sure that we can separate the distribution yield concept and the total return concept. So even if we are in an environment where interest rates come down, you will benefit from that increase in capital gains, which will offset that lower distribution yield in the future. Yeah, I think there's a few other questions that are. Let's see if there's. I think a lot of questions we've answered.
That's one on Fed independence.
Let's see that question.
Maybe I can address it. Yeah, there's just one question here on Fed and independence and what are the implications do you see for U.S. equities bonds? Yeah, definitely. I think it's been recent in the past few days and weeks, and actually it's not the first time when Trump has taken a stance against Powell, and specifically, if you're watching the news last night, you saw that actually Trump made some very targeted remarks against Powell and pressuring them to cut interest rates. I think at the end of the day, when you look back, the central bank independence has been the pillar for the U.S. monetary policy, and staying independent from that of the administration is a very, very important part of credibility for the U.S., the dollar, the U.S. equity markets, and even the Treasury, right? All those are very, very important factors that we have to consider when we look at the markets today. And traditionally, also there's some news around basically how it's actually very, very difficult for a standing president to make that happen. So I think we'll have to continue to monitor the situation, but it's definitely adding more pressure on markets. We saw overnight U.S. equities falling 2% each. So definitely it's weighing a bit on the confidence, but I think this is something that we have to continue to monitor.
We'll be I think most of the questions coming in are quite similar, so we'll be, I think, wrapping up quite soon. But I just want to make a last point, maybe answering some of the questions together, which is, I think questions around a tilt. Our Endowus core portfolio is still heavily tilted to U.S. markets, or are you diversifying into other markets? And do you think investing in Europe market in this climate is good, et cetera, et cetera? So just wanted to go back. Actually, our flagship portfolios are already diversified into multiple markets, and kind of going back to the dimensional commentary, actually dimensional invests into more companies than index funds. So it's even more diversified than some of the index funds out there. And from an exposure perspective, we've always highlighted the importance of diversifying outside of the US, and currently our flagship is actually overweight emerging markets, like Geoff had alluded to. And so that is important. Having said that, we don't take particular market views, so we don't go overweight Europe, China, et cetera, et cetera. And quite frankly, the reason why we're overweight emerging market is not that we have a positive view in emerging markets per se, but it's because we feel the current index actually underrepresents the actual emerging market, economy and so on and so forth. So it's more of a structural reason than anything else. But the view of trying to go overweight Europe or US or Japan or China and so on and so forth is your individual judgment. It's our job to give you the best tools to do that. Now, personally speaking, I think the performance gap that we're seeing, particularly into China and some markets of Europe, has been somewhat long overdue, and so that kind of mean reversion is happening. But for the long term, investment, you have to see whether those drivers will continue, to see whether you want to actually overweight those markets, right? So, for example, going back to the U.S. market, we've always been advocating diversifying outside of the US, but it definitely does not mean you want no exposure to US. US is still a very, very big part of the global index. And I think for good reason, a lot of the companies in the US are not just companies that operate in the US, they're actually global companies that actually have businesses worldwide. And yes, because of the concern over tariffs impacting those global businesses, that obviously has an impact on the price. But companies are resilient. They normally adapt to new situations as well. And some of the best companies are still listed in S&P 500. So I don't think you should ever rule out S&P 500. It's just that we want to have that diversified approach globally. Okay. And I think with that, yes, I think we've covered most of the questions.
Okay, so maybe with that, we're reaching the hour. I just wanted to do a quick wrap up. If I can leave you with two key takeaways for today. Diversification remains the mantra of the day. During the turmoil, we have seen that certain sectors and regions are faring better than others. It really highlights the importance of keeping a well-diversified portfolio. Volatility is a natural part of investing. Staying invested and don't try to time the market, and maintaining a long-term perspective on your portfolios can help you stay focused on your financial goals despite short-term fluctuations. As always, our advisors are here for you should you want to discuss anything on your portfolios. With that, thank you and have a great day.
Thank you.